Most left-wingers believe that their lavish social programs of giveaway goodies can be paid for by increasing taxes on the rich. They speak of having the rich pay their fair share and of increasing taxes on fat cat corporations. This last point misses the fact that at the end of every tax is a pocket or a purse that it comes out of, and corporations do not have pockets or purses. What they do have are employees, customers and shareholders. And many peer-reviewed papers have shown beyond doubt that corporation tax falls mostly on the workforce. It takes in taxation the monies that would otherwise have been available for wage increases. But there's another fact of life that works to undermine left-wing redistribution. It is that higher tax rates do not always bring in more revenue. Indeed, in many cases, they bring in less. The leftist fondly supposes that doubling a tax will double the revenue. So if a 10% tax brings in £1 billion, a 20% tax will yield £2 billion. No. They overlook the fact that all taxes change behaviour. A tax increase will often make people do less of what it is being taxed. Governments raise tobacco taxes not just to raise revenue, but to encourage people to smoke less. When income taxes are raised, it decreases the rewards of work, making it less attractive to do more of it. The tax increase discourages greater effort by limiting the rewards it would bring. It also makes it more worthwhile to hire expensive accountants to find ways of legitimately avoiding the tax. It might not have been worth doing at the lower rate, but it becomes worthwhile if people think the rate is too high. These two behaviour changes can reduce the amount of income to be taxed and therefore reduce the revenue raised, even though the rate is higher. The opposite works in reverse. Lower tax rates make effort more worthwhile, leading people to do more work, and they make avoidance less cost effective, so people do less of it. The result can see more revenue yielded by lowering the rate rather than by raising it. The economist Arthur Laffer, 80 years old on August 14th, unveiled two obvious facts. If you plot a graph with rate of tax along the horizontal axis and revenue raised along the vertical one, then with a zero rate of tax, zero revenue will be yielded. Similarly, if the tax rate is 100%, zero revenue will also be raised, because effort would be futile if you gain nothing from it. Between the zero revenue raised at 0% and the zero raised at 100%, there will be a line. This is the famous Laffer Curve. That curve will have a maximum point, the level of tax that raises the most revenue. Empirical studies indicate that the UK top tax levels are already above that maximum point, so that raising them would reduce revenue rather than increase it. Furthermore, they suggest that if we reduce the top rate, we'd raise more revenue by doing so. This actually happened in America with the Kennedy round in the 1960s and with the Lawson cuts in the UK in the 1980s. More tax was raised at lower rates. Furthermore, at the start of those UK cuts, the richest 10% in the UK had been paying just over a third of total income taxes. After the cuts, they were paying just under half of the total, from a third to a half. So, by all means, have the rich paying more taxes and paying their fair share. But we achieve this by lowering the tax rates, not by raising them.